Hey guys, how you doing? I know that we haven't had the greatest year investing, and it was a little bit over a year ago that I talked about how I thought that the market was potentially in trouble. So what I wanted to do today was talk to you guys about the history of bear markets and just work through some of the actual worst bear markets that we have seen since 1950. You know, how much they dropped, how long they lasted, how long until they got to the break even point. And I'm going to talk about a few tips for some people that are especially worried about this happening, early in retirement when you have to draw income. We're just getting absolutely hammered by inflation. Some things that you can maybe do to protect your investments, but not completely take yourself out of the market and make the number one mistake that everybody made when this happened in '08, which was that a number of people in 2008 sort of thought the world was ending. These giant banks were going out of business. They said, I just cannot handle the stress anymore. I know that it sucks. So they cashed out their investments and bought long term GICs with all of their money and actually missed out on the rebound. And generally speaking, when people do that as well, then they're just too fearful to ever get back into the market. So it's sort of something that I want to avoid having anybody do, but I don't know what's right. I do not know what the winning strategy is in these cases, but I know what the best strategy sort of is generally speaking, if you can ride out these storms, if you can keep cool, if you don't have to actually sell during these times, then you're going to see light at the end of the tunnel. Even though if it gets that bad, then it's not going to feel like the light is ever going to come. So I know it's easier said than done. But what I'm going to do here is I'm going to talk about the the bear markets on the S&P 500 since 1950. This isn't going to include the Great Depression. As you can see, there's a number of them. I'm not going to go into every single one of them, but I am going to take a deeper dive into the worst five that we have seen since 1950 and look at the averages there. And the S&P 500 is a good thing to look at because it's very easy to understand what the S&P 500 is, which all it is the top 500 companies in the United States. And every single time that one of these, bad market, bear market things happens, what's going to happen is a number of these companies are actually going to potentially go out of business or, just no longer be within that top 500 of the companies. But there are going to be companies that actually innovate during these times. And actually, now you get to start buying those companies as they're entering their growth stage. So that allows you to actually sort of feel that rebound because you're going to be buying those companies low if you own, say, an S&P 500 ETF that is just buying all of those companies and not actually picking and choosing the stocks. At the end of the day, the stock market has always been a good place to invest because historically companies are just built to make money. They're never going to always make money. It's impossible for a company to grow every single year. This year, you can imagine it's very hard for companies to actually make money because it's costing them so much more to keep in business. Customers just aren't there necessarily, but that doesn't mean that they're actually going to go out of business. That just means that their value is going to go down for a while, but at some point in time, they're going to rebound or other companies are going to take their place. And that's why, Warren Buffett and whoever else, all of these guys that have gone through this a number of times, do not worry about these things, even though I know that it is really hard not to worry about these things. So we'll just look at this graph really quickly, and it goes through all of the bear markets since 1950. It says when that peak hit and when the trough came. So the trough is when it's going to hit the bottom. And so it says the percent decline over that peak to trough time, how long it took from the peak to the trough. So as you can see there, the average percent decline is just over 30%. The number of days is 338 days from peak to trough. And then the number of days that it took to hit that break even point again. So basically it's 338 days down and then about that same amount of days to go back up, a little bit less than 300 days to get back up. So from peak to break even, the average time of a bear market has been 1.7 years. So I'm not going to break down every single one of these. What I wanted to do was talk about the worst five. And I personally remember kind of three of these, and then I wasn't alive for the other three or the other two. Uh, and then we've also, obviously we had one in 2020 that was pretty intense but lasted for 3 weeks and was the weirdest thing ever. And sort of one of the reasons why I thought that this is going to happen is because that was sort of just a false sort of thing that happened, and it was like, that should have happened, it didn't. The market then rebounded like crazy because a whole bunch of money got dumped into it, which I should have seen coming. If you really think about it, obviously the stock market was going to go up and the rich were going to get richer if the government was just pumping money into sort of the system. Then the big money was going to make a whole bunch of money, and eventually that, all good things must come to an end. So let's look at these five and let's talk about the length of them and how big the decline was. Because if I was a betting man, I would suggest, and as others have, and some people say that, everything's fine, don't worry about it, inflation is transitory, we have absolutely nothing to worry about, real estate prices keep going up forever, all of these things. I am not in that camp. I personally believe that this could actually be a pretty substantial bear market, could lead to a recession, potentially a depression, in my opinion. Do I know that? Of course not. But let's say, what if we're mentally somewhat prepared for that? If this is now, we've almost entered a bear market as of today. It's June 13th. It's just after midnight. The NASDAQ, the tech stocks have been hammered all year. Anybody that's been invested in crypto is definitely in a crypto bear market. It makes sense to think about the speculative stocks, the ones that were really rising, the ones that people were making huge gains on, to be the first sort of thing to fall, if you think about it. And potentially everything else might fall afterwards. So you might see the crypto crash sort of comparable to the 2000 dot-com crisis, because everybody was buying anything with sort of a dot-com behind it because they were super excited, even though there was no actual value behind it. And I have to assume, since I looked the other day, there's over 19,000 cryptocurrencies, that the majority of those are absolute garbage. Of course, they're going to lose money. And when people start losing money there, then, they might potentially start losing money elsewhere. So anyways, I don't really know anything about the 70s crashes because the two of them seem to be the same to me, but the sort of 68 to 1970 crash was a pretty substantial one. It was a long one as far as the days of decline. It dropped just over 36%, and it was 543 days of declining values in the stock market. However, it barely took over 100 days, 107 days after the bottom for it actually to hit back to that break even point. So I'm sure there were a hell of a lot of people at that time wanting to get out of the market, could not handle seeing, 2 years of declining values, getting hammered, and then they would have missed that sort of getting back into the market and actually hitting that. And then they have to buy in late, and they've missed a very substantial amount of growth because there would have been, a 36% increase over the next 107 days. The 1973 to 74 crash was huge. I know this is also similar. So the sort of the 73, 74 one, the dot com, and the financial crisis one, to me, seem like they're all kind of happening at this exact same time because that was the time where we're talking about, inflation rate, like there was stagflation, which is sort of that thing going on. So at that time, the market dropped 48% and dropped for pretty much 2 years. And it took a very long time after that 2 years for another 4 years for break even to happen. So it was slow growth coming out of that, which would have been because of that stagflation. So it's really hard for, companies to grow when there's a lot of inflation. However, it would have been slow growth. So, at least you would have seen the values coming back. You're not that worried about it. The 87 crash, the only thing I really remember about it is because it happens at the very beginning of The Wolf of Wall Street when Leonardo DiCaprio's character is like basically his first week on the job, and then just everybody sees the crash happens and it drops. And this was hard and fast, very similar to the one that we saw in 2020 when the market just dropped super hard and fast and nobody really had any time to do anything. Nobody was doing anything, which was good because most people weren't actually selling out at that time because they were just like, holy crap, I don't know what to do. I don't even have time to think. We're in the middle of a pandemic, and then the market rebounded like a few months later, which is why I didn't put it on that one. It was just sort of a blip on the radar. But that one was short and sweet, but it was one for the record books for sure. I alluded to the 2000.com crash. I think it's kind of similar to the crypto thing, as I said, because there was a whole bunch of craze, a whole bunch of people putting a whole bunch of money into the market, uh, and just having these huge returns for absolutely no reason. And obviously, that came crashing down and brought the majority of the market down with it. However, at the same time, good companies that you would have owned at that time would have done just fine because it didn't throw everything into hell at that time. From what I recall, it was, like a lot of people lost a lot of money on the stock market and probably a lot more than 50% if you were mostly invested in, Nortel comes to mind, of course. But that number of days of decline was 929 and, took roughly twice as long as that. So 4.6 years from peak to actually break even. So that was a pretty long stretch of time. And then, of course, we all remember the 2008 financial crisis, which was the biggest drop since the Great Depression. almost 57% on the S&P 500. This was, the mortgage rates. Everybody was foreclosing on their homes. This could potentially happen again if interest rates rise too high because inflation is so high, people will no longer be able to actually afford their homes. So it isn't for the identical reason that happened in 2008, where, lending practices were just absolutely ridiculous in the United States, but because now sort of the uncontrollable happened and inflation has run wild, which could potentially lead people to not being able to afford their homes and a lot of the debt that they might be carrying. So that decline lasted for 517 days. What is that? A year and a half or so, and took another, 2.5 years to come back to that break even. But what I talked about was as people were seeing that come down, and I remember this because I wasn't in the business in 2008. I started in 2011, and what the big companies were talking about was saying, in 2013, 2014, there was going to be just a record number of GICs coming due. At that point in time, there was going to be a ton, like trillions of dollars of liquidity coming into the market. And they were talking about sort of this sales opportunity of the biggest liquidity event of all time happening because these GICs were coming due. Like I said, though, most people that got into that felt like they were safe. They never rebounded and they kept their money in GICs or something like that for the remainder of time and haven't seen or been a part of the longest bull market stretch in the history of the stock market, which happened at that bottom. Because the market has basically been going up until January 6th or so of this year, which, if this is the start of the bull market, then it has been going on for roughly half a year, or a bear market, sorry. It has been going on for roughly half a year. So let's say that this is, as bad as all of these or a little bit worse, and we take the average into account, then we are potentially anticipating a 45% or higher percent drop in the S&P 500. It's dropped about 20% since the peak at this point in time, so it could keep going if that happens. The number of days of decline on average is 544. You can see there's a huge difference between the five. It's 101 days to 929 days. So it's absolutely impossible for us to even remotely guess as to where the bottom is going to be. We have absolutely no idea. You know, so that where I would start talking about is we're seeing it go down. At some point in time, if you have money sitting on the sidelines because you've been anticipating this, then something to consider is to now start dollar cost averaging your money into there to say, okay, you know, and if you're young, if you're my age, younger, or have 10, 15 years until retirement, I would literally just not actually think about this. Just make sure that you have a well-diversified portfolio. Look once every 6 months or once a year. Don't worry about it. At the end of the day, the money is going to go up. If the entire market fails, then you could have never done anything right. If the zombie apocalypse comes, your money doesn't matter. If the Great Reset comes, your money doesn't matter. So if you anticipate that companies can and will continue to make money in our lifetime, then you're going to be okay by just sticking it out. And that's what you should do, because that has always worked throughout our history. And if it doesn't, then I promise you, you're not going to be the one that gets it right the other way. So, I wish we knew that, but we don't. So that's where you have to worry about it. However, everybody talked about 2008 and like retiring in 2008 and saying, well, you're screwed if you retired in 2008 because you needed your money then. But the truth about retirement is that you only need a fraction of your money in the first few years or in each year of retirement. It's not like you're cashing out your entire nest egg that year. So, and retirement should last a really long time. Hopefully, you live a long life. You have the ability to rebound. The average rebound time takes 3.58 years. So, you say, okay, well, what if I'm really worried about this? Then an idea, which will not be the winning idea, but it will not be the losing idea, is to keep the money that you need for the next 3, 4, 5 years, let's say, sort of on the sidelines, potentially in a GIC ladder. Now that interest rates have gone up, at least they're somewhat getting close to keeping up with inflation if they can tame it a little bit, obviously. But, you can get GICs paying 3 or 4% right now to say, okay, I'm going to cash out the next 4 years of the retirement income that I need. So let's say I need $25,000 a year out of my RSP. I'm going to take $100,000. I'm going to put 25 in cash. I'm going to put 25 in a 1-year GIC, 25 in a 2-year, and 25 in a 3-year. At least you won't lose money when it comes due. You sell it out. And that's what you take out. So now you're not selling at the absolute bottom. You're not really worried about it. You can sleep at night, and that's really what you need to do through these times, is not look every single day, not worry about what happens day to day, because life is long but short. Your investment time horizon should be long. If you only have a few years, then you should not be invested like this anyway. But your retirement's going to be long, and we cannot sort of worry about these things day to day. I know that's easier said than done. It freaks me out because I hate it, because I wish that I knew a way to make it go away or win or whatever, but I just don't. There isn't one. These things happen, and the best investors in the world are the ones that stay calm during these times. So I had a piece of advice, and even for people that are retired, take your own advice on this. So if you're younger like me, or even younger than me, you're just getting into investing and you're wondering, like, what the hell do I do? Go and talk to somebody that has been through 3 of these, that was invested since the 1980s or the 1970s, and say, what did you do during those times with your investments? And if you could change that, would you have been better off had you just stayed invested and actually stuck with the plan with a well-diversified portfolio? And the answer to that question almost every single time would be yes, and I should have invested more during that downturn. And if history repeats itself like that, then that is going to be the winning formula for everyone. So I hope you learned something from that. I hope you're doing well. I know that this is a stressful time. And take care of each other. Keep kind. I don't like seeing all this garbage on the news. I hope people are doing okay, and we'll get through this together. And that's about all I can say, I guess. Take care of yourself, and thanks for watching.